share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Tonight's video, we're going to talk about the rejection and the reversal that occurred yesterday after pumping over the 6,000 level. Let's get into tonight's video. Well, welcome everyone. Interesting overnight session. Going back the last 24 hours and looking back at what happened, there was a trade on the fact sheet that came out on the S&P that suggested there was a breakout trade heading up to the 6,000 level, which we printed up to, I think, 60. I'll look at the numbers in a minute, but I think it was 60.08, maybe printed 09. I actually got short at 07 last night after the London Open. Traded it down pretty good, but took them out before I went to bed. Should have left them on, still had them on. But there is, I think, something very substantial happening here. If you look back over the conversations that we've been having on this channel, going back maybe a week even, been talking about how we're just kind of starting this slow rollover. We still have, we're still printing over the 5,900 level, but the 6,000 level was just more than it could be handled. There's no justification. I always love it, appreciate your comments and everything. A bunch of guys tell me market's going to the moon today, which didn't do it. I was talking about the potential of a reversal. I talked about this in the Substack last night, that there was a risk of the markets failing up here. I've been also going on and on about the fact that I thought if we make a new high, we'll get rejected. So yesterday is very interesting when I show you the data sheet, the technical structure assessment out of the data sheet. Sharp pullback, failed breakout. And I would argue that's exactly what happened. Since I programmed the sheet to think like me, it's doing a pretty good job. But the scenario that's happening out there is, everybody was with the courts mingling into the government and telling Trump what he can do and can't do, agree with it, not agree with it. Markets pumping, NVIDIA news out. NVIDIA had a big reversal too. That was pretty much a climactic move as well. But what we're seeing here is folks, and this, I talked about this in the Substack last night, is folks think that, the tariffs coming off, that's bullish, but I keep arguing that even if the tariffs go off, let's say we set the clocks back to January. What was good about January? What was good about the economy? We're starting to see the labor markets, maybe a little fringe on the edge, starting to deteriorate. We saw claims come into 240, the continuing claims at 1.19. My magic number is over 2 million. That's going to be a thing. I think we're going to continue to see deterioration in the labor markets. You have to understand that last year and the year before, maybe the year before, we were getting all these fictitious numbers and pumping. There were, I'm in Arizona, right? So, literally thousands of people coming into the country every day and millions showing up. And this was inflating the record. The Biden administration used government hiring, the border crossings, all of these things to pump the numbers across the board to make things look good. So it was inflated. And I remember people calling out like, okay, hey, Bob, the markets aren't that good as we thought they were. But I argued then that we have to pay attention to these numbers coming out because they do mean something, because market participants, people that are sitting by the screens like you and me and making decisions to put money to work, are watching these numbers. So whether they were pumped or not, and I even, especially after the, 800,000 jobs that were taken back on the audit last year from the employment line. So we've seen all the smoke and mirrors stuff. Now what we're seeing is a little bit more reality. There's nobody coming over the border, which feels really good being here in Arizona, and there's everything's kind of been frozen. So when we look back, and if Trump never said Liberation Day, none of this ever happened, we'd still be dealing with these cross currents that are starting to come into the markets. And I argue here, those of you that are regular watchers, I've been arguing for literally months as we came into this year, is really what we're doing is, and I still believe this, and I went through a deep dive last night in the S&P talking about the monthly charts and some of the longer term trends, that we're really just basically consolidating 2 years of 52.5 compounded return for 23 and 24 in the S&P. So we're still dealing with kind of burning off that energy and consolidating and trying to reorganize things. Meanwhile, we got a lot of different things happening around us, and I think most, as it turns out, what's the new term? Taco for Trump, right? Gets in and it looks like he's backing out of all these deals, but I think he's been neutered now because of the courts getting involved. So people were celebrating that yesterday, and I was in the Substack last night going, this is actually not bullish, because now it's taken powers away from Trump and the U.S. president to negotiate with people. They're like, hey, he's got no power, so why should we do a deal? Why, that's just another layer, and it's just interesting. Having watched, I don't know, I'd have to count, every president. I've been in the market since 1979, so coming into the end of Jimmy Carter, who I voted for, okay, I'll admit that out loud at the time. And then when Reagan ran after Jimmy, you had no choice but to go with Reagan. But the point is, since I've been through all of these iterations of the U.S. government and things, and it's interesting that hindsight, probably some of the better times outside of the Reagan reversal of a lot of taxation and everything that was going on then, inflation, stagnation, everything that was happening, probably the Clinton administration was one of the more successful runs in government for 8 years. They actually downsized the government. They did a lot of stuff. Rubin was the master of on the Treasury, and he did just an amazing job on getting the U.S. debt just restructured, and that was set the tone for a lot of years looking forward. So where am I going with this? I think that where we're at right now is even more vulnerable than we were before. I'm not predicting a collapse of any sort, but I'm telling you, we're going to have to rethink everything that we're thinking. And the fact that if they took all the ability for Trump or anything to take the tariffs away, it wouldn't change the economic picture. The economic picture is not necessarily that good. I'm still hanging on to my thoughts of Q3, Q4 of a somewhat of a back, where the economy is going to show some negative numbers. Tomorrow's trading, Friday, will be the final trading day of May, and that will be one more month to the end of Q2, and then we're going to be coming into Q3, which will be dog days of summer, and we'll see how everything plays out. But I don't see anything that positive to point to, and people tell me it's going to the moon and all that. I don't see it. There's just nothing to drive the markets right now, and the lack of tariffs doesn't mean anything. Matter of fact, the tariffs are probably more positive than negative. It's just It's everything that anything Trump says is negative, right? So we know that. But the point is here is that there's nothing, if you take all that away and none of those words were ever said, we'd still be dealing with some other elements that have been set in motion going back to the couple last 23, 24 of the Great Pump and the Great Lie, as we know now that we don't even know who was running, who was president during that period of time. So here we are, folks. That's all I'm telling you is that what we're seeing right now is we're going to have to rethink all this stuff and start to put this together. So that starts to bring uncertainty and some downside. So let me check the database, make sure it's updated, and we'll move on. This is basically the broadcast for Friday's market. So tonight is my Friday night. But let me just look here and just see if we've got everything updated and ran here. Bear with me one second. Yeah, it looks like everything's done. So here's the plan. I think I'll bring up NVIDIA tonight since everybody's thinking about it. So let's see, within the sequence, I'll go through the normal database, S&P, NASDAQ, then we'll do NVIDIA. We'll just talk about that. Not going to do any other stocks at that moment. And I'll roll on to the treasuries, which are starting to come in line with what I talked about several days ago. And then from there, we'll go to the back end. We'll cover gold and go on to Bitcoin. And Bitcoin's getting very interesting as well. I think there's some potential changes that are going to happen there that maybe some folks aren't going to be that happy about. So let's go ahead and get into the database, and I'll also bring up the data sheet. I think you're going to find it really interesting. And so if you don't get the Substack, get it, kendallreport.substack.com. It's $8 a month. You get 4 markets, 8 trade recommendations every day, and lots of data that you can set up your day trading off of these fact sheets. And on the Substack channel, by the way, pinned on the top, if you go to the homepage, I think you have to be at least a free subscriber to get it. But there's a large document there that goes through every aspect and discusses exactly what goes on in this data sheet. It looks like a flat piece of paper, but there is a lot of calcs going on behind it. So check that out. All right, let's get into the database here. Okay. So we're at 67. We had 332 new buys, so we actually had a positive rotation. Market was up 0.25 or something like that. And then we look at 67.17. The metrics on the database, 62 to 58 is support. That would be actually healthy if we were to get some selling to come in. Like I said, Friday will be the final day of this month of May, and it also is a day where we run our intermediate models. They've been coming back in. They got just above 42%, which is a minimum market. I'm not sure. I might be able to bring something up on that. I think I will. But the patterns that are starting to unfold here is just really kind of a rotation on the short term. So we got up to, I'll show you in a minute, we get into the S&P, but we basically have gotten into that full valuation point where the markets get, and now it's like, what's next? You got to show me the money. And we're not getting, like I just said, don't have anything out there that would be advantageous to the market to skyrocket to all-time new highs, start some new bull market, and everybody's hurrah, and there's nothing out there. If anything, what's hanging out there is the Trump administration winning in the Supreme Court and knocking all this stuff down, and then we get to regurgitate the entire tariff syndrome again. So, like I said, I don't think this is a positive. So we look, So what we get, 170 exits, a little more buying than exits. So we did see that get up there. So nothing more. I'm going to bring up the weekly database real quick. Weekly is at 42.26. I suspect that we will see this improve a little bit more. And just let me see if I can grab something real quick here on this other monitor. Let me bring this up. And this is kind of the working towards being the new face on the portfolio manager. So this is right out of we're 42.48%. We start to look at some of the rotation that's going on here in the sector distribution and those things. If you get this sheet, I usually put the link to this right now, so it's almost like having part of the WaveTech database at your fingertips as well. But we can go over here to sector analysis and kind of look at what's going on. These are the daily short-term sectors, and so we're getting toward the end of this pattern. Let me just come over here. Yeah, so there's a lot of stats here on giving us some of the expectations for the models going forward. And if I put this in the Substack, make sure you click around here. So there's a lot of little messaging and things and intelligence that is in this as well. And I'm just looking model performance. Yeah, so just back to this overview page. So we're right at 42.48 on the weekly. My expectation is that we're going to see this go. And this is an interactive sheet, so you can see it shows you the data in the database, what's behind this chart as well. So make sure you check that out. But we're definitely seeing the patterns that we're seeing here is definitely still supportive of the market's consolidating here. There's not, like I said, I'm not looking at any kind of collapse or anything like that. All right, so let's go ahead and get into the S&P. We've been just climbing, stair-stepping up, and we've gotten to this point here. Let me just bring up this chart here so you can see, it feels really good, but we're starting to get this big whipsawing consolidation here. I still think what we'll see is that the algos, you can see the dots, which are the projections of where the markets are heading. I think this 200 that's coming through here will continue to be a good solid support level on the short-term basis. I went through a lot of depth, so if you want to see some deeper thought on the intermediate and long and monthly charts, go there. Tuesday night, my plan is to do a deep dive on the long term as we come into the final month of Q2. So we'll start to set up, look forward maybe for the next couple quarters. I think this year gets really interesting. If you think everything's going to be wonderful, I don't think that's the case. I think there's a lot of potential downside. Maybe 48.30 ends up being the on the futures here on the S&P ends up being the low of the year. Could be, but I'm still not convinced this is over yet. One of these, I hate making these comparisons, but it is what it is. This is basically an extended right shoulder right now, and if it fails, we have a failure line here. These green dots here. This is a pivot number that we can look at here. It's right here. I don't think we get below it, but you see it over here, 56.57. That is going to be the number where we're likely to get. That's where major support's going to be. We do have, this is a daily, so we have the 40-day coming up in here. We look at the algos. I've been talking about this as well. We're looking at a general loss of momentum after this push up. If you look at this has been almost, we look at this rally after, let's go back to maybe the end of April. Let's look at May's rally that we keep grinding up. This has all been generated by, I don't know, just news generated, not economic generated, but news out with the tariffs and all these deals that have been going on. There's no economics behind any of this rally. And that's where my concern comes in. I always tell you folks to do this reverse analysis. Well, you know, there's nothing in this rally that was substantive from the standpoint of that, you know, this big economic event happened. You know, Trump can scream about all of his deals, and, you know, he definitely got some signed deals out of the Middle East. There's some real money there. But all these other deals, people are going to build this, going to build that. Most of them are handshake deals. I don't know that there's that many of them in writing. So it's just political rhetoric that we're getting, and that's what's got this market to here. So there's no substance, in my opinion, behind where we are from a fundamental standpoint, and from a technical standpoint, we're starting to see these things deteriorate fairly rapidly. And I think we'll, even though, I mean, we're just stuck along this 5,900 level, right? So we're looking here. Let me just bring up the numbers here. Yeah, we're 59.10 right now. Yeah, 59.10.25 on the futures. Nothing going on here at all from the, you know, it's just kind of hanging. And if I went through the closes in the last week, let's just do it. 59.50, 59.53. Then we got a 58.50. Then right back here, 59.46. 59.25, 59.17, and 59.08 last. So we've been flatlined completely. And we could go back even further. And this has just been just this choppy, one little dip in there. What I would expect that we'll see is we should see in the next several days as we come into next week, and we come into the 1st of June, what we're going to get is probably more consolidation with maybe a little downward bias, okay? And so now it's time to reveal this sheet here. And this is the sheet from today, and I thought it was kind of interesting the way that it played out here is 45% neutral to bearish. So this is the first bearish report we've had. The one thing that has been really consistent every night when I show you these things, when I put it into the Substack, we've been getting basically bullish upward numbers, and there's been an underlying bullish sentiment on this market for a while, okay? And it just continues. This is the first report we've gotten where we're starting to see some deterioration starting to happen. So I like it. Volume exhaustion, failed 6,000 breakout. And I said it last night that, you know, if we get above 6,000, that there's no oxygen up there. I said that in the Substack newsletter last night as well. There's nothing to grab onto here. And just what my commentary I just was giving you is telling you there's no economics behind this rally. Zero. You know, if anything, we're seeing labor market starting to deteriorate. There's other things happening here. And so now we're seeing the technical and the quant, and this document behind it has 26 pages of calculations. So they look like a flat piece of paper, but it is a monster document that is considering all the stuff here. And this is the big report here. Let me just pull this up. If we come down here to the PPMs, we now have we've got the ppm2 in maintenance. Everything's neutral, and now ppm1 is neutral as well. If we get down below minus 0.15, it's going to go into trend mode down. And so this is what we'll be watching. We look at the market grid calculations here. Right now, R1 59.42, 55%. So right now I'll show you another spot on the sheet. 58.92. We have not made it down there yet. That is, so the stars here is the calculated high-low is S1, R1. That's what these are telling us. And then they're giving us some values down here below. 59.42 has a 70% volatility being the high. 58.92, 85 probability. That's probably what we're looking at a range. We have PCE coming out tomorrow. We do have some inflationary numbers, things of that sort coming. So, there's a possibility of some elevated volatility. So I should have mentioned that on the front end, but I'm just looking at some of my notes here. The PCE on income is expected to be up. Prices 0.1 increase both on core and just the price calculation out of PCE. So no expectations of anything. And I just kind of reference in here while we have this up on the screen that we also have, the FOMC minutes were deemed a joke because all they talked about, one of the main things in there was the tariffs and the inflationary impact. Well, they've been frozen. So for right now, all those worries are gone. And I mentioned this yesterday, is that, this is the entity that's supposed to be data driven, and they're worrying about something that hasn't happened. So, it's always interesting, right? To watch. So these are interesting numbers here for us to look at, because this is showing the deterioration here. So let me go back to let's go back to the chart for a minute. So this is what right here, where these algos are suggesting that we're going to see momentum starting to die off, and especially as we come into July. These calcs will change as we get real data, but it gives us an expectation. And like I said, on Tuesday night, I'll go into the deep side of intermediate and monthly, but I did do that last night. So go watch the first section right after the database last night. It's a fairly long section. I must have spent about 20 minutes on that. So, but the point is, this is a key setup. I have always used the S&P. I know some folks watch the Dow Jones. I haven't looked at Dow Jones in 30 some odd years. I don't even know when the last time I've looked at it. It's probably a good trading vehicle today with the liquidity levels that we have across most markets. But the S&P represents a really sweet spot of the economy. And I always tell you that the NASDAQ and S&P are cousins, right? They have many of the same components in both indexes, especially at the top end with the Mag 7 setting in both of those indexes. Obviously, the tech index, the NASDAQ, has a little higher beta. Everything's a little different from that standpoint. But but what we're seeing here is that deterioration going on. So let's go ahead and mention that NASDAQ. Let's move over. We did get a more pronounced reversal yesterday, and so this rejection, it actually was. This is interesting. Let me back up a second, folks. I may have missed a good detail. Yeah, I did. So let's talk about something. I'll carry it back into NASDAQ. Sorry, just happened to see this setup. So one of the patterns that I talk a lot about, and it's set up here. So this is very interesting, and I'm glad I caught it on the NASDAQ, because I tell you, these are not scripted live streams that I do. These are live analysis. One of the things that happened, we did make, if we look at today, Thursday's action, we traded up almost to the extreme, but what we did, we got a reversal. We closed just a touch lower, but we made a higher high, a higher low from that. There is a video on my channel. I need to do a better job because it's embedded in there. I need to put out this trade. It's called a 3-bar trade. So when we get a reversal like this, there's basically, you want to get short on probably this S1, and it's going to be, let me bring this up. It's going to be around that 5942 number that's out there on that data sheet I just showed you. But you would want to get short there, use a stop over Thursday's high, and the market has to do two things. It has to make a lower low, and it has to close lower. So that tells us from here, we have to get you some numbers. 5884, we need to take out that number. And if I recall, I'm going to bounce around just for a second. This sheet here, so 5892, 5864 would be S2, okay? So I'll put this together. So what that tells us, we should trade down to 58, 60, 70, right in that range. Chances of making a new high are probably fairly low. We do have PCE, which could be a big report, but maybe if it comes in minus 0.3 or something, then they can bounce this market back up toward the highs. But for right now, this from a technical setup that goes there. So back to the Nasdaq. Sorry about that little divergence there. But so we have this outside bar. The red dots are projecting us down into this rising 21. I always tell you, I do not use trend lines. I would rather have market, the values being driven. Let me just draw this in. So this 21 period moving average here and this 10, we should come down and trade into this range. And I don't know, I can't get you the number at the moment. I will, but we should trade down into that little wedge, and we'll take a look at this PPM. Let me back this up just for a second so we'll get a little technical for a moment. Is what we would expect is for the markets to kind of come down and possibly break through this and then head back to here, which is the 200-day. If we get this formation, what we're gonna have here is probably like an ABC. We've been getting a lot of these little patterns where I think ultimately we probably end up in this wedge, which would be the 10-day moving average, and we end up trading down into back towards the 200. And is there going to be more than that right now? I don't think it's possible to see, but this is kind of the pattern that we're setting up. If you recall, when we were coming up out of this level, when we got here, there was a possibility that we could have done this. Well, we got one more leg up, and now we're probably ultimately, I know I got a lot of lines. This last line I'm drawing here, this is probably the extreme, or this green dot here, which is also on the S&P, is going to be that number. That's 19,901. We'll call it 19,900 is that key level looking back in here. So let's clean this up. So the PPMs are telling us momentum's going to drop off. Any of you that have been around the channel know this, but there's something I talk about, the angle of attack. This telling us the angle of attack is getting low enough that the moving averages are likely to be penetrated. My whole career started in 1979, but around 1983, 85, we did this analysis of trying to figure out it was a much simpler time then from technology and everything. But trying to figure out a simple moving average, what was, when was it vulnerable to be penetrated, and if it was rising, or what were the characteristics around these moving averages? Well, we ended up developing an entire philosophy around that question, okay? And the question is there is some characteristics that moving averages, that's why they bounce sometimes, and people go, oh, it bounced off the 200. Well, wouldn't it be nice to know if it was going to bounce off of there, if there was some probabilities you can put on there? And that's what we did, is we started looking at the moving averages and trying to put those probabilities. So all of these indicators are part of the probability map, and determining what that angle of attack is and whether it was going to break through there or not. It's very, very simple thought process, but when you put it into practice, then we built trading models around that have a lot of rules that are watching for different increments around that will keep you in these trending markets. So right now we're still, we're in that process of that final probably topping phase to come back into a minor correction, and the minor corrections can grow into something bigger. So hopefully on Tuesday night, when we dig into the longer term, that we'll be able to determine exactly what's going on there. Okay, where are we at on time? 36, good. Let's go ahead and let's go to the treasuries. Maybe we'll touch on touch on the dollar as well. So a couple of days ago, when we printed up to 4.63% on the 10-year, and remember that this was the day we had the end of the world, that there must have been millions of videos out on how the bond market just told us the end of the world. What I still had what I call the high water mark is 4.72%. If the 10-year were to break that would be a problem. But one of the things that happened was we had nothing else to call it but a failed 20-year auction. And if you look at the amount of 20-year bonds in the market, they're next to nil. No one ever shows up at that. I went through this over and over. So this was no one shows up at the 20-year auction. They haven't, my whole career for 45 years, they haven't showed up. Okay, it's really a gap filler in the balance sheet, but the primary is the 2 5s, and we'll throw 7 in there, less of that's kind of a filler as well, and the 10 and the 30 on the back end. The 30 used to be the big play. When I first started the market, there wasn't a 10-year futures. There was a 30-year futures, but not a 10. And I think the 30-year future at the time was a 6% coupon, if I remember, 8% coupon actually. So the point is that the 10-year. I mentioned Bob Rubin. Rubin reconstructed during the Clinton administration the entire balance sheet of the U.S. at that time, focusing it more at a little shorter rate at the 10, which gave it a little more flexibility when yields were changed to roll the general cost of money for the government. And so it was a brilliant move. I still think he was one of the best Treasury secretaries we've had. And but the point of this is, what we're seeing here is the 10-year really is the focus, and everybody, was talking about, remember when the inversion, the two 10s were inversion, and that was the end of the world, and there's going to be recession, and I kept telling you there's not going to be a recession. That's not going to be the reason for it. That inversion was forced. It wasn't market driven. So I won't go down there because I could spend some time on that. But the point is, what we're seeing here now is we're seeing this the 10-year pull back into this 440 range. I've been advertising 3.95 to 440 being kind of the range where the 10-year should probably lie right now with the structure of the Fed funds and everything based on Fed policy and everything's going. That they basically have drawn a flat line, 4.25 straight across the board, right? The back end's just slightly elevated. And I actually talked about that for about a year when they started raising rates. That's where ultimately we'd land. Now the next phase will be we need to get that front end down, and then the back end's not going to change a lot. And I see people talking about the real estate markets and things, and need to get yields down. They're not going to change for a little bit. I'm not sure that they're ever going to get down to what once was. You know, when you had the 2.5% mortgages out there, that's not happening. And so, basically, what we're seeing here in the 10 years is things starting to flatten out. It's coming back into that normalized range. Right now, we're at 4.43. Probably coming back towards a 40, 435, maybe back into even a 425. You can see the algos here are projecting everything going down. So let's do the Dow real quick. We got about a little over 15 minutes to go. So this is also encouraging, bringing up the Dow, is the Dow looks like it's going to continue this recovery. You see the red dots here are forecasting a little higher prices. Probably going to stay under the 200-day, but all the algos are showing us a steady rise in the Dow. And I talked about this the other day when the 20-year failed, right? What you have, what you want to watch for is if treasuries are going down, which means yields higher, and the Dow going down, that's bad, okay? That's just tell you there's liquidation going on in treasuries. Now what we're seeing is treasury are rallying a little bit, rates coming back, and the Dow's stabilized and starting to move higher. So at the moment, there's no danger. I'll do my best on Tuesday night to go through most of the markets. I just need a couple of days of trading so I can get the algos to kick in, and I can make analysis of the intermediate to longer type formation here from that standpoint. All right, so natural here to go from here to gold, and gold is locked in the range. It's whipsawing around. It'll be interesting when I do the Substack letter. Just so you know, Substack letter comes out just a few hours, usually about 5 a.m. Eastern time. I work late at night. Best trading there is around London on the E-minis. It's a great time if you're up and about to be involved there. But what we're seeing here on gold is really just kind of moved off the lows. Now we're back locked into a range. We had some fib targets up here that were getting, one of them was reached, and now looks like we're flatlining, and I think gold's just going to stay in this range. And like I said, I'll bring up weekly real quick just to bring a bit more perspective in. And this looks, what it's telling you, there is a big bull market going on here in gold. If you look at the forward forecasting here, and even the red dots are trying to move up, but what they're moving up is saying above, this is the 10-week moving average. Simple moving average, 10-week. Let me just get you a value here. 32.57. Anything along this line is a buy within this pattern. But what I was discussing with you yesterday, this volatility that we've gotten over the last several weeks is really still needs to normalize before we can start to go in any kind of accelerated trend. So I think we have a number of more weeks, but we should stay above this 10-week moving average. All right, let's have some fun. Let's see, where are we? 44, good deal. I forgot to do NVIDIA. I told you I'd do that. So we'll do NVIDIA after Bitcoin. I apologize. It's so out of sequence from what I normally do. All right. Let's just stay with the weekly Bitcoin. So let's start off with this first. There are live Fibonacci targets right now for Bitcoin for a move. I'll just blow this up so you can see it on the edge here. 134, 213, 150, 157,000, 171,000. That's the target zone for these fibs. But I've been telling you we have several more weeks of strength to play into. I do believe that this upper range, this 109, 110 level we printed last week. Last week 112 even. This week 110, 789. We've got an inside week working right now. And my concern here is, I'll bring these up, is that we do have a few more weeks of expanded momentum that tells us that we'll stay at least above the 10-period moving average. But I think we've got to roll now. I think it's breakout now or fail. And if Bitcoin's going to act like a risk-on asset, then the other risk-on assets are telling us that they want to back up right now and get some softness, so it could pull Bitcoin with it. I still think 105, just magic, nothing magic about it. 105 and 100,000 even. We have to stay above those numbers. If we get back under 100, that's going to scare some folks, and we could see some volatility kick back in and see some selling coming back in. The scary part is that as we get out into the toward the end of June, we have that's kind of the window we have to rock and get to this 134, at least fib target 1. So I just told you what it was. Yeah, 134, 200. That's a shot right here, right now. If it fails to get, that 112 now is the new high water mark. If it fails to get above that, then we're going to have some issues, but there's still substantial amount of support. So basically, there's not huge downside here of any means, but there's the risk becomes when a market has the right conditions set and it doesn't run. It's like you kind of got to find another buyer more than Michael Saylor, right? So you got to find some new buyers to come in, and they're, I'm not sure what kind of things will drive this. I certainly don't think J.D. Vance showing up at a Bitcoin convention is a good thing. I went through that last night. I think you want the government away from this, and that's that. So I don't really see that happening being a good thing. I don't like the government being involved with any of this stuff. I actually hate the fact that there's ETFs and options on it. It just makes it too mainstream, and it wasn't supposed to ever be there, and that's what everybody wanted, or I'd say the bulk of people wanted legitimacy, and I guess they got it. We'll see what plays out of this. It's a concern for me. All right, so let's do NVIDIA that I promised earlier. So let's do the daily first. Let me go through that first. I hate stocks that do this. We broke out and gapped above the market grid. We were actually, I'll go through some of the indicators here in a minute, But we got this spike up. We had 3 fib targets that were out there from April 29th. And those targets were, let me just pull this out. The first target roughly was 123. And then I'll blow this up so you can see it over here. We had 134, 141. So we exceeded that fib target 3 that came out in April, April 29th. So about a month ago, we had these fib targets here. We satisfied that. We basically have a climactic type pattern. And let me just bring the indicators back. So what was interesting is that NVIDIA was looking just like the S&P, where we were rallying, but the upward momentum was burning up. We still have a plus 0.28, and that is significant in that anything above 0.25 is considered to be an uptrend. So we're still in an uptrend. It looks like potentially as we come into next week, we could actually see everything roll over and be negative. And so we start to spin out a little bit. We basically had that same pattern. I believe this is probably all-time highs, 140. So we probably printed a new high here. Let me get the weekly so I can. Yeah, 153.13 looks like. 153.13 looks like the high water mark here. This is a weekly now. And we do have some Fibonacci targets on the weekly here. I'll just bring this up so you can see them here. Is 149, 172, 187. So there's certainly some patterns there. But when we bring up, this almost looks like the Bitcoin. We have another few weeks of elevated trend from the PPM1, which tells us that this 10-period moving average is coming up underneath the market and it's likely to stall. We look at the market grid for this week. Those targets were I'll bring it up on the side screen here. 142, 139, 142 is RTX, and we got to 143.49. So we basically did the full range of the expectations for this week. Chances are we still have upward momentum coming into next week, that the market grid turns up and we form a little upward channel. So we could still head up toward that 153 level, but that daily reversal is kind of a bug in the ointment, meaning that we're probably going to see a little bit of backfilling. If we look at the red dot predictions, it's suggesting that we're going to head back to, let me get some numbers here. We'll call it 130, maybe an extreme down to 120, just broad range, broad stroke. So it doesn't, we'll see what we get out of this. Even if we get the market grid weekly to turn up, it looks like there might be some positive movement there as well. All right, let's see what you guys are talking about. Yeah, I'm just looking at some comments here, folks, see if there's anything that. Yeah, so somebody says, gosh, Bob, you've been saying this since the bottom. I think what I've been saying is, yeah, it's true. And this is, come on Tuesday night, because basically all we're seeing is a correction. All right, so
yeah, meanwhile, I think we bought 10,000 stocks in our database. We bought, thousands in our intermediate database. So there's been an accumulation here. So you have to understand, I look at what I'm trying to do here is give a macro viewpoint of what's going on in the models and what the markets are doing. So, I have been saying that. So you want me to say something that's not happening? What's your point? Let me just see here. But I appreciate the comment, really do. Just a couple more things. Let's look through some earlier comments. Yeah, and somebody was saying that the numbers are front-loaded. That's what I'm saying. And we're not getting the inflated numbers as before. Let me just look at a couple more comments here. All right. Nothing's really jumping out at me. But, yeah, so but let's talk about a little bit about that because let me just come full screen. Yeah, so let's talk a little bit about that. Yeah, so since the bottom was one day. It was 11% day. Since then, we spent about 6 or 7 days within the range of that 11% percent spike that we had on that Wednesday of Liberation Day, right? So the markets came out of that pattern and have been climbing up, and we've been participating. There's been some great trades in here. I know somebody, I think I saw their name on here, but if you get 8 trades every day, get the Substack and check these out because there's some really good trade setups, especially if you go and look at that. I'm gonna show you something. This will be a moment since it's the end of the week here. Let me just see if I can get something up on the screen. I can never find this when I go here. Hang on one second. It should be here. It is. Okay, so I'm going to show you this screen. So this is what I would suggest. So right at the top of the Kendall report, this is the different reports. But if you click on this one here is the comprehensive user manual, and it is in depth. It goes through all the key components, talks about each Fibonacci targets, everything here. It is a big document. I wanted to have more graphics in here. I'm going to break this down into a little bit a better form, but in here is also the theory. Let's see if I can find it. It's a big document, trust me. Here it is. So this element here is the probability map and what everything's going. This is really good. So I think free subscribers, you get to that home page. It might be even open, just pinned to the top. You don't even have to subscribe, but you can find out about that particular sheet that I put out every day. And like I said, I'm in the process of refacing. I started putting a complete new dashboard together last weekend. I've got a project that's going to give you the top 20 stocks, I think it's the top 10 ETFs. I think there's 30 items in total. I built a portfolio with them, which is pretty interesting, looking at top volume, top activity, and all stocks. And that was my criteria for picking them, that everybody's watching and that there's a lot of volume and things going on. So it was kind of interesting. It was kind of a non-biased way to build a portfolio. And then I added in the ETFs, and I'm working on that project. And there's going to be a dashboard that you'll be able to access eventually here that will break down all the details of all the stocks, the portfolio performance, and I've now built in expected performance looking forward based on the characteristics and the models and what they normally achieve during a cycle. So there's a lot of really cool stuff. That's why I spend probably 2 hours a night on Substack. I spend 3 to 4 hours working on these projects and getting them up to speed. So anyway, as always, we're right at 1 hour. I appreciate everybody watching, participating, love it. You know, like I said, the only rules on this channel is you just don't call me names, and you can disagree, whatever. I love the interaction. So that's the only rule that I really care about, is that I don't want to be called names. So anyway, that will do it. Folks, have a great weekend. It was kind of a weird week with the holiday and all that stuff, but we got through it. So have a good day trading tomorrow. Make sure that you like and subscribe these videos. And thanks so much for being here. Appreciate it. Final music. I've got some new music coming next week.